Good evening and welcome to the Theo Night Report for Thursday, October 5th. So here we have yet another day of upside breakout on the major indices. The S&P here is up 14 points and screaming to the upside. And that is not the only thing that is screaming, is just about every trader that I hear during the day just can't believe it. So this is causing a massive amount of pain, not only to those that are short, but also it's been proven that the pain of sitting on the sidelines, watching a market run away without you, is actually greater than if you had taken a stop loss. So this is also being compounded by institutions that are way behind the curve for the year and are being forced to just hold their nose and jump into this and just chase after momentum. Technicals don't matter to them. This is a purely momentum play as we see the shell game of money rotation continue to play out into the fourth quarter. Now, when I look at this chart, certainly it does seem to be a little stretched to the upside, but I'm going to make a statement here which is a little bit controversial, which is that the chart is doing exactly what it's supposed to right now, with one caveat to that. Now, let me start by looking at the recent charts into the summer of the weekly and the daily chart. So we're going to just focus on the right side here. Now, when we got into this period after the last rally that we had up here, which is into the summer, what we've seen on the weekly chart, so we're going to focus on the middle of the chart just for a minute here. What we saw in this area here was just a very large consolidation here. And it didn't seem like it at the time. It seemed like a continuation of the rally. But we had our days there, we had our weeks where, somebody was shooting off missiles and things like that, bringing up negativity into the market, which ultimately got pushed out to the upside. But the net effect of this is that it built up the weekly chart. It's kind of like a spring coiling up here. It coils up tighter and tighter and tighter, building up more potential energy. Eventually that spring is going to get unwound and is going to unleash that energy on something or some market, in this case the S&P. Okay, so that's kind of the larger time frame perspective. Let's forget about this chart over here for a minute. That's my caveat. So now we're going to move down to a smaller time frame, the daily chart. And the daily chart is going to be more of a child time frame to this parent chart. In this case, the weekly chart is going to be a parent. Daily chart is going to be a child. So when we were sitting there going through this essentially flag behavior and all of this stuff in here, this is all weekly chart, consolidation. Yes, there are trends inside of here that we could have taken, but what you're seeing here is that as we finally broke out, as we got into September here, the daily chart went into exhaustion. And this is the point where we typically think, okay, range expansion. So it moved about from 24, let's call this 2430 up to 2500. That's a 70-point move in the S&P. That's typically about how far a swing will go on the S&P. On an average daily swing will go about 70 points or so. Very common. And then from range expansion like this came range contraction as the price consolidated within here until it too also built up that spring. Kind of the same thing happening here at the larger time frame, built up enough energy to be able to support trending movement again, and off we go. So now what do we have? We have once again exhaustion here. So what I would expect to see if this is playing out is that, especially since this is a little stretched up here, at some point we should also start to see this play out, and then the game will continue until such time that we break out to the upside, maybe even move up to 2600. At that point, we'll probably have also a weekly exhaustion. And then we get into this odd period where we have not only monthly, but weekly, but daily. That could also happen. So we may be just another couple of moves away from ultimately seeing a larger pause in things. Now this over here is my big caveat, because I've never seen the S&P reach this level of exhaustion on the monthly chart and stay down here, honestly, for this level of time, down at this level without seeing some kind of major reaction, whether or not it was the reaction that we had over here in 2010. Remember the whole flash crash that we had during that time and that whole summer of kind of indecision before finally the Jackson Hole statement drove the markets 400 points higher from that point. And then we had all of 2011 here, right? And then we had some periods in 2013. We had some extreme exhaustion in 2013, but we did have enough shake and bake during this time to be able to basically recharge this chart. And of course, we had this big consolidation here, 2015, 2016. So now we're getting down into some weird territory here. We haven't been in some time. It's going to be extremely odd not to see this at some point here in the near future pull down into a larger range. Now again, this is what I've been saying from day one, although I've been saying it several times over the last few months, is that eventually this is just going to lead to a bigger range. This is not going to lead towards something like this. And I know that you read all of these articles and you're convinced that you're going to wake up and the S&P is going to be down at 1,200 by the end of the week. That's not going to happen. The market doesn't move like that. There's enough things that happen where the first move down will be bought. We will just move into a different and larger range. Now I'm teaching a class this weekend on what's called the trap trade system. And the trap trade system really talks about the fact that when we have a change in polarity, when we have an established trend, in this case to the downside, what happens is that the smart money pretty much catches this up near the top of this to the downside. And who I would call the not so smart money is going to wait until things feel a lot more comfortable than that before they're also going to look for that short trade. So essentially what happens is they wait until all the way down here before they start to enter their short positions. Now think about this. They don't have a strong hand in the position. They have no tolerance for loss. They have no tolerance for risk in the position. And they're pretty much running right on the razor's edge of getting blown out of the position. Well, what happens is when they collectively get blown out of that position, it will help drive it in the opposite direction. So this is an area, now that we've seen this signal today, now we've printed a higher low and the price is making what today was a higher high. And so we're seeing the first beginning of this signal. Now, something else I'd like to see is the trend line being broken to the upside. So there's no guarantee that this is going to work out, but we do have a valid change in polarity right now to the uptrend on Apple. So Apple's been downtrending pretty much since the announcement when nobody was really all that excited about their new product offerings. But if you go back and look at Apple, we've been through this story before. It tends to happen is that Apple eventually turns into a cash machine and outperforms. So buy the rumors, sell the news. Right now, Apple is breaking out to the upside. And the way that I would play something like this is typically through just an in-and-out spread. Something like this where we're buying the at-the-money option and selling the out-of-the-money option for this and trying to get about unity. So we want to pay no more than about $1.25 for a $250 wide spread. Okay, folks, that is it for today's report. Thanks for listening, and we'll see you this weekend with a weekend report. Take care.